Good afternoon. Welcome to this webinar on scaling up sustainable finance and investment in the Global South. My name is Dirk Schoenmaker. I'm Professor of Banking and Finance at Erasmus University and Chair of the CEPR Research and Policy Network on Sustainable Finance. And together with my colleague Ulrich Volz, who is also on this Research and Policy Network, we edited a really excellent collection of papers on these issues. And then a warm thanks to all the authors contributing. And a few of them are joining us today in the panel for a deeper discussion on the issues. The link to the ebook is in the chat, so you can all download it. And thanks to CEPR, that's all available for free. We really enjoyed making this ebook. And it is really important because we really need to scale up climate and SDG finance, not only as we do a lot in the North, but also in the Global South, because the consequences of climate change are far more severe in the Global South. We all know it at the equator, rising sea levels, weather patterns. So the benefits of climate finance and SDG finance are very big for the Global South. They're much needed. Yet the flows go the other way around, from the south to the north. And that's really a pity. And I think the financial system, and let's take collective responsibility, all the listeners, whether you're at a central bank, at a supervisor, at a private financial institution, or an academic like Uli and me, whatever you are, collectively we are responsible that, or we should take responsibility that the capital flows are going the wrong way. And what we try to do with this book is really to open the dialogue and to come with new solutions, how we can do what is needed, that the capital flows are flowing, the net capital flows are flowing to the Global South. That's really needed. And I think we have a few big observations in the ebook. First of all is let's organize domestic finance in all countries. If we can get the institutions better, then we can keep a lot of money at home doing the good work. Then, of course, we need the multilateral development banks to help out. That's why we have them. And I live in Europe, and the European Investment Bank has now turned into a climate bank. And that's what we need to do everywhere, that we recognize these needs. And then private finance, pension funds, insurance companies should chip in. That's the big challenge. For me, there are two issues. First of all, financial institutions and also still countries are well versed in looking at economic and financial returns. And they have a blind eye to the social and ecological impact of financing. So I think number one, what is really needed is that we include impact in our calculations. So not only the financial, but also the impact return. I'm now working on a textbook on corporate finance. It is possible, you only need to want to do it. So number one, the global and the domestic financial sector should include impact. And the second thing is, I worked for 10 years at the Ministry of Finance in the Netherlands. I worked at the Bank of England. We really need the development banks, the national ones, the international ones, as catalyzer of kickstarting this process. That's why we have governments. That's why we have these banks, multilateral and national development banks. They should be the initial investors and then pooling private finance into it. So that are my two main suggestions. I'm really happy to hand over to Professor Ulrich Volz, who's at SOAS University and visiting at London School of Economics, who has done most of the work in editing this excellent ebook. Over to you, Uli.
Thank you, Dirk. And before I do a little bit more of scene setting, I'd also like to very cordially thank the contributors to the ebook for their excellent chapters. I'm really glad we were able to gather such a great group of people to contribute to the volume. And I'd also very much like to thank the team at CEPR for a super efficient handling of the manuscript. But now let me add a little bit of contents. I'll try to not to take too much time. So it's very, very clear. I mean, we're a week ahead of COP, and we all know that climate finance is far too small. There are enormous investment needs in both adaptation and mitigation in developing emerging countries. But it's not only the climate agenda, there's also the Agenda 2030, which requires huge amounts of investment. And there was a big financing gap, which the UN estimated to be around 2.5 trillion before the pandemic. But this has widened quite dramatically. And when we look at the trajectory of international private capital flows to emerging and developing economies, the picture is really quite bleak. And when we look at the global financial cycle, which has been turning, we see that now private capital is increasingly pulling out of developing and emerging economies. And we now have rapidly rising interest rates in major advanced economies, which make investment in the global south comparatively less attractive, and indeed much more difficult, because we have this huge risk premia in most countries of the global south. And on top of that, we also have now a massive sovereign debt crisis building up in dozens of developing countries. And the sad reality is that many emerging and developing economies will have to have their debt restructured before public and also private investment can resume. So without addressing the looming debt crisis, we can really forget about scaling up investment in a lot of places. But if you take a bit of a longer term perspective, even before the pandemic and all the crises, or the poly crisis we're experiencing now, attempts to lure private capital at scale into emerging markets and developing economies have not been successful. And we have to be very clear that the billions to trillions agenda, so the attempt to leverage private sector capital through project-based blended finance approaches, has not been successful at all. And so we really need to rethink how we can mobilize private capital, both domestically, but also internationally. I think Charles Kenny from the Center for Global Development put it very nicely when he said that the idea that you can use a little bit of public money to mobilize huge amounts of private capital is really, it's not just fiction, but it's a fantasy. And so we really need to think about better approaches to mobilize international capital. And as Dirk just mentioned, right now we actually have a lot of capital flowing in the wrong direction. So a lot of, or a large part of developing country savings are invested, and often at very low or negative returns in the financial centers of advanced economies. And then often we see these capital exports from the developing world being channeled back to developing countries in the form of high yielding but short-term debt or other portfolio investments, which of course has all kinds of adverse impacts on financial vulnerabilities. And especially developing Asia and also oil-producing Middle Eastern countries have been running huge current account surpluses and exporting capital. even in countries that are net capital importers, which includes most sub-Saharan African countries, there have been significant amounts of domestic savings that have been invested abroad in safe hard currency assets instead of the local economy. And that's a big problem. So we really need to look at better ways of mobilizing domestic savings in developing and emerging economies, and strengthen domestic financial systems so that there can really be a scaling up of local climate-friendly sustainable investment and reducing capital exports from developed to advanced economies. And there are, of course, a lot of elements to that, but that's certainly a key point, is certainly strengthening local currency bond markets. And there are a lot of innovative ways of doing that, often using new fintech approaches. And there's one very nice example from Kenya, where the government of Kenya has raised money for infrastructure projects by issuing retail bonds that could be bought by small-scale individual investors on their mobile phone. So a tokenization of bonds can attract new investor groups. At the same time, we also need more aggregation to entice institutional investors, both domestic and foreign, who usually have some minimum investment requirements to invest in projects such as renewable energy, which are typically more small scale. Dirk already mentioned the great importance of public development banks, and we'll talk more about that. And we're very happy to have Stephanie Griffith-Jones with us, who's been pushing this agenda so much. Multilateral development banks and national development banks have a critical role to play, and they are really also institutions that can help to scale private capital, but not through this blended finance, project-based blended finance approach, which hasn't been really working at scale. But they can issue large scale bonds, could be green bonds, whatever, to attract private capital, to lure private capital into investments in the global south. And I think we should also be discussing much more about strengthening national development banks. And there's also, I think, an important role that multilateral development banks can play in that respect, for example, by strengthening governance, but also providing capital, credit enhancement guarantees, and so on, to help national development banks attain better credit ratings and be able to issue bonds in their local markets at better conditions. And a lot of things I'd love to address now, but we're lucky in that we have a lot of great contributors to our book, and they all have a lot of interesting things to say. So I spare my thoughts for now, and I have the privilege of chairing the second panel, so I can chip in some more of my thoughts as well. But let me now hand over or back to Dirk to chair the first session. Thank you.
Okay, thanks, Uli, for giving the overview. And so I think it's quite clear that the agenda is urgent. And I'm always surprised that we make these promises at the COP and the new one is coming up, the Global Climate Fund, and we all know we need 100 billion, and that it is so difficult to fill that, while it is so obvious that it is first best to do that. And so we have a long road to go, and that's why I'm extremely happy that we have among the contributors three who are in the panel and want to share their thoughts on top of their chapter. And I think, as Uli said, we really are very lucky to have this diverse chapters in the book. So the first part of the book is the general issues, and that's what we do in the first panel. And in the second part, we share country experiences, and like the example of Kenya, where people from Kenya can chip in financing their own infrastructure, which is really powerful and creates ownership. So general and country. So we start off with the general one. We're very lucky with the first speaker, Karim El Ainami, from the Institute, and I have to be careful, the Policy Center of the New South, and has been at the Central Bank of Morocco and has been at the World Bank. So he really knows from the global perspective what's needed, but he also is now with his feet at the ground, what is needed at the country level. So Karim, I'm really looking forward to your thoughts on the topic.
Thank you very much, Dirk, and thank you to both of you, Professor Volz and you, for your maestria in managing what is not always easy, a collective effort.
We hear you very difficult, Karim. Your sound is not...
Am I back? Is it fine now?
Slightly better.
Okay. So
This is fine, yeah.
I would like to thank you, yourself and Professor Ulrich Volz as well, for this initiative and also for the maestria with which we have managed this collective effort. Thank you. Well, let me be very brief as you asked us. I think there is something that doesn't work, and both your introduction showed that there is a market failure in a way, an organizational failure, where we have huge needs, in particular in Africa, but also at the global level in terms of greening infrastructure. And finance is not playing its role, basically, to put it very simply. We don't see the scale, we don't see the capital flowing to invest itself in what is, as economists, we see with solid, profitable rates of return. Given the population growth in Africa, you had a little bit of something, and then you have basically the rate of return of those investments in the long run. So it's not working. It's not working because it is complex in terms of aligning the interest and the incentives of all these actors. You need to have a serious pipeline of projects. That's what we discuss in the paper. Needs to have the data, the regulatory framework in countries here on the continent is not necessarily giving the sufficient comfort to investors. As often in infrastructure, you have natural monopolies, and the regulatory framework of the government plays an important role. Simply to take a simple example, if it fix the price of electricity to end users, then for a producer that has a long-term concession from the government, this is a serious issue. And there are many examples of the like. But what we would suggest is that it needs to be organized, and it needs to be organized by governments or multilateral banks. That needs to provide a sort of guarantee, an underwriting mechanism that will allow these flows of private capital, and you've said that are in excess. We have, in a way, a saving glut given demographic trends in advanced economies. Pensioners need return for their pension. And one of the greatest sources of growth in the future is both the green transition, but also Africa as the last frontier of development, to put it simply. So we have there a nice combination, and it's not happening. You alluded to it there, and the mandate of multilateral development bank has to evolve to be consistent with that. And we need to use the fantastic innovative power of finance to good purposes. We've seen finance innovation creating lots of, to put it in a mild way, lots of challenges for policymakers around the world. But we need to make innovation in finance at the service of this objective, which is basically the needs of Africa is 5 to 6 percentage points of GDP every year to sort of respond to the advancement needs of their goals, be it the SDGs or the Agenda 2063 of the African Union. And so far, there are some responses. You mentioned one, blended finance, but I think it's not at scale. And my suggestion, to move away a little bit from the paper, which our audience can always read, is to take an experiment concretely at, let's say, let me take an example from where I sit, could be between Europe and the Mediterranean region, or Europe and Africa in general. And let's take an important sector, energy. And let's try to organize, which is this sector, and let's start to test and experiment what we advocate for in the book, basically, what's the role of different actors, how we can provide guarantees and to crowd in private investment, what's the role of the government. And actually, it's by essence something where we can build interesting partnerships, since most of the renewable energy, be it solar, wind energy, or hydrogen, can be produced on this side of the Mediterranean, and you have important demand on the European side of the Mediterranean. So far, we are seeing bilateral deals. We are seeing governments at the national level doing things with multilateral banks, of course. I'm not saying they're not doing anything, but we're not seeing a massive sort of flow of capital being invested on the basis of, the general law of finance, rates of returns, arbitrage, etc. We're not yet there. So my messages would be, let us experiment on one sector, let's experiment on something that has a partnership dimension between let's say, the South and the North, to draw the lessons and have and test what works, what doesn't work, what are in concrete terms the impediments and the obstacles. Thank you very much.
Thank you, Karim. That is really great, because we always have this debate: is it the supply of money or is it the demand? Are there sufficient projects? And we can talk forever about it. And I like your idea. Just get going with a big experiment, and we all need the energy sector. Like Africa had a big thing of no telephones to mobile telephones. So we all wish you in Africa from small energy infrastructure to a renewable energy infrastructure. And that would be great if on this big scale we can help out and not experiment like with the euro. In Europe, we say the euro is not experiment, that's for real. So for real, make this big infrastructure investment happening, and that would be great. So thanks for the suggestion to bring it at a bigger scale and just get going. I'm from the Netherlands in Rotterdam. We always say in The Hague, they talk about the money, that's our government. In Amsterdam, they spend it, that's the capital. But in Rotterdam, we do the work, get going. And I like your spirit of taking a sector and just get going. And that fits in for the European Investment Bank, for example, in the climate bank mandate. So a powerful suggestion. Okay, I now turn to Stephanie Griffith-Jones. And Stephanie, big welcome. We all know you. You have been around as a famous economist on all these issues for a very long time. So we are very glad you are joining us. And you are the first one to really understand and know the importance of these multilateral development banks. Uli and I already said we really need them. I think Karim confirmed that. And we are really looking forward to your view on how we can empower the multilateral development banks to get going on these topics.
Thank you very much, Dirk, and thank you for the invitation both to participate in this important book and in the launch of the book. As both Dirk and Uli have emphasized, at the international level and in countries, there has been a real renaissance of the role that public banks and development banks in particular can play. This started after the North Atlantic financial crisis. It's emphasized even more throughout the COVID pandemic, but they're even more important now in view of the difficulties that exist at the international level due to the invasion of Ukraine by Russia and the risks of inflation and recession globally. And as Uli emphasized, because of less and far more expensive private flows to the global south. I think the first point is to say that private financial markets seem to have, as Stiglitz has pointed out very clearly, more market failures than government failures. And that is why intervention is necessary, both in financial regulation, but also in public development banks, because financial markets are flawed and full of imperfections. It is not that public intervention is perfect, but they have less, it is less imperfect than private financial markets. And there's another imperfection which relates to the creation of the green economy, where the fact that there's so many externalities, so much uncertainty, radical uncertainty today because of climate change and because of other considerations, that it is very difficult to attract private flows on their own to finance such activities. And therefore, it is very important. There's a strong need that has been increasingly recognized for development banks due to the limitations that private finance has. And furthermore, long-term private loans are scarce and expensive, particularly for the developing and emerging countries. This makes it especially difficult for smaller and newer companies, who are often the most innovative ones, to access credit. So while we have these difficulties in generating sufficient private finance, we have a situation where the ecologists tell us the planet cannot wait, and we do not have another planet, so we have to do something about it. As Dirk also mentioned, some banks have already taken very important steps. The European Investment Bank, the Bank of the European Union, the largest bank amongst the multilaterals, is becoming a green bank because 50% of its loans since 2025 will be destined to green investment, and they cannot do finance any investment that is harmful or that is high carbon. I think another less known development is that in the US, after a long discussion, the US Congress and President Biden have recently approved the creation of a federal green development bank with an initial public capital of $27 billion, and which will be channeled particularly through the green transformation, and especially in areas that are poorer within the United States. And this is, I think, a clear recognition of the important roles of development banks, particularly in the green transition. And in developing and in emerging economies, there have also been a lot of creation of new development banks and expanding new ones, including in Central and Eastern Europe. So we see that development banks have a crucial role at the multilateral, at the regional, at the national level. And it's interesting to stress that they already finance 10% of global investment, which represents more than $20 trillion of assets and over $2.5 trillion of annual lending. So they are important actors worldwide. And they're important both in emerging economies, in low-income countries, but also in developed economies. As I mentioned, in Europe, they're very important as they have large players like the European Investment Bank, but also, for example, Germany's credit KfW. I think it's important to stress that a balanced approach has to combine both public and private institutions. I think this balanced approach implies a paradigm shift, because instead of discussing whether it is the role of the state or the market in finance which should dominate, it's much better to acknowledge the complementarity of both actors and consider the strength of each one of them and how best they can work together. And this is what we have tried to study, for example, in the book that we did with Jose Antonio Campo, who's also a very early promoter of development banks, and he's now Finance Minister of Colombia. I think it's important to stress that an important advantage of development banks is they're able to leverage public resources to maximize impact on development. And this is particularly helpful in situations of fiscal retrenchment and low growth, like we are unfortunately now, with high debt levels, as Uli pointed out, and high inflation, where public resources become particularly scarce. And then development banks are especially valuable to leverage public resources and have a greater impact on green transformation and recovery of the economy. And of course, another advantage is that they tend to fund very long-term loans. That is, they are patient capital, which allows the investment in the structural transformation for new sectors, new companies, for example, in the energy sector, as Karim so clearly outlined. They, of course, play an important counter-cyclical role, but I don't really, and they did that very significantly in COVID. But I just want to very briefly say that they are crucial in these crisis periods or post-crisis periods to keep long-term investment active so that one can both mitigate the effect of crises, both financial and COVID-1, but also so they can support continued growth in the future. So development banks supported, for example, in the COVID crisis, the solvency of companies and preventing many of them going bankrupt, which would have led to big increases in unemployment. But also, they continue to provide financing for investment, which is so crucial for the transformation we need. But I want to stress one element to which I will return, is that it is very key that development banks have enough scale, that is, enough capital to be able to respond quickly in difficult periods, both of crisis and for the structural transformation. For example, multilateral banks like the World Bank have had insufficient capital to help, which is disappointing. As I said, the key area that we're interested in this book is the support for long-term structural transformation, and particularly the support, for example, for innovation and entrepreneurship in national economies, where development banks are a sort of bridge between the public and the private sector, and they can contribute in significant ways to, for example, finance the energy sector. And here I would like to highlight that for example, in Germany and then in China, the public development banks, KfW, and then the Chinese development bank, played absolutely key roles in helping the transition, for example, to far greater use of solar energy. And this work that was really catalyzed and initially funded exclusively by the public development banks led, in the case particularly of China, because of the large scale of the economy and the big push which they had, to a significant lowering of the costs of solar panels, which has actually made solar energy cheap worldwide and competitive with fossil fuel energy worldwide. So there we have an externality, not just for the countries themselves, important as that was in Germany and in China, but also for the global economy, and particularly.
Stephanie, can we finish on that high note?
Okay, can I just finish maybe by emphasizing that we had a big conference, a summit on public development banks in Paris, the first one. And one of the key recommendations was to ensure that the capital of development banks is at sufficient scale so that they can fulfill these important roles. And for countries that are poorer or very poor, like in Africa, and debt restricted. Maybe one should think about the potential of new instruments like using existing SDRs to help capitalize the African Development Bank so that it can lend more to African countries who are in such difficulties and great needs. Thank you very much.
Thank you, Stephanie. And I think you make very clear, although you're not explicitly saying it, with your discussion about the market failures at the start, I think we need to recognize that the market economy, by turning a blind eye to impacts, so they only look at economic and financial return, cannot really deal with these long-term issues. So the multilateral development banks, as an old finance ministry person, I always call them the off-balance sheet agencies of governments. It is a revival of the government, and we really need it. And I think your example of solar energy in Germany and China is a clear example that the multilateral development banks and the national ones can kickstart transitions. And now solar is so cheap, the private sector can take over. But for the kickstart, we really need the government to take the lead, take the initial risk. And I fully endorse your plea. Let's scale the multilateral banks up, because that's the most effective way of investing here for the governments. Because by scaling up the multilateral development banks and your own national development banks, you can really, the multiplier is at work if you will do that. So thanks for stressing that point. But then Samantha Ettridge from the Overseas Development Institute, I'm sorry for you, Samantha, because you really have the hard ticket today. Because I think everybody is already stressing, and Uli also in his introduction had the blended finance that we all learn at university. We teach to our students that the beloved model, public, private together, and then we can empower because the government has not enough money, but extremely difficult in practice. So I'm really looking forward to your thoughts on blended finance and the future of it.
Thank you very much, Dirk and Uli. I'm delighted and thrilled to be part of this and have been invited to contribute a chapter, probably more a kind of practitioner kind of perspective than an academic perspective on the reality of kind of like what that landscape actually looks like. So I think just at the beginning, a couple of kind of throat clearing kind of things I need to say. The first is I'm going to focus more on the kind of, the mobilization of kind of international capital or cross-border capital, rather than this really important issue around kind of mobilizing domestic savings and capital and local capital market development. So that's just in terms of the scope of my remarks. And secondly, a very brief kind of nod to the, what I'm actually talking about when we say blended finance. So, it means many different things to many different peoples. There's no common definition. And there are actually broadly two definitions out there in the universe. One is a very broad definition, which kind of looks at the use of all development finance, whether that's kind of public or private, to mobilize additional non-development finance, which wouldn't normally have been invested in support of the SDGs. And then there's a much narrower definition, which is really used by the institutions who actually do the hard work, the DFIs and the MDBs, which is really just about using, it's not the whole universe of their investment, but actually a very small subset of their investment where they use external concessional resource with their own account resources to invest. So for the purposes of this discussion, I'm actually going to use the broader definition, which is aligned with the OECD definition. So I'm going to be talking about the universe, if you like, of DFI and MDB investment. And finally, when I talk about MDB investment, I'm talking about their kind of private sector operations. Anyway, now I've cleared my throat, I'll just go in and make a few kind of points. And I think we've heard, so I won't dwell on it, I think kind of post 2015 and with Paris, there's the mobilization of private finance agenda is really at the heart of the discussions about how we're going to kind of finance and achieve these goals, but also recognizing the complementarity between public and private. But I think there was a big focus or shift in, if you like, how we were going to do this, and this emphasis on private, and hence, you know, kind of the role of the DFIs and MDBs, for the reasons that Stephanie's kind of outlined about their development mandate and financing models, the critical role that they can play to unlock private finance. And then, of course, there's this big hype, you know, kind of the promise and excitement and the rapid growth in the pools of impact capital that we see. The IFC estimated it was, I think, 26 trillion is currently managed for impact, about 10%. The OECD argues if we could allocate, you know, just 1.1% of that, we could, you know, bridge this gap. So there's this kind of rhetoric out there that there are these pools of capital seeking kind of positive social and environmental return with purpose. And if we could just, you know, tinker, we'll be able to, you know, solve this problem. And so this has led to, you know, a lot of hype. And actually this agenda became synonymous with the billions to trillions agenda, although that was more broadly conceived originally, you know, to include public finance, domestic revenue mobilization. But anyway, many people understand it as kind of about mobilizing private finance and blended finance. And as we've heard, progress has been quite slow. So despite this huge kind of growth in appetite and these rapid increases in pools of capital seeking this kind of impact, we haven't been able to channel it to where we need it to go. And I think there's lots of figures, facts and figures out there. But just, I mean, often when we talk about mobilization, I'm always struck in the discussions I'm in, people talk about it, but don't really appreciate, well, what kind of magnitudes are we actually looking at? And I just say, you know, progress has been slow. The MDBs and DFIs publish, it was an annual report, hasn't been out for a couple of years. But in 2019, they report that they mobilized, and it's quite a generous, I think, kind of methodology, about $63.6 billion. So again, we need to anchor the kind of expectation, and actually that had gone down since 2016. So, you know, this is this thing I think you mentioned about kind of capital coming out, the difficulty about mobilizing capital and how that has become much more difficult in recent years. Our work also talks about kind of quite low leverage ratios and very little flowing to really, you know, the most challenging of markets. Now, Karim mentioned, you know, we need to acknowledge the external factors and that this is a very complex issue. You need a conducive enabling environment first and foremost. And, you know, no amount of kind of subsidization by DFIs and MDBs is going to, you know, solve this if the enabling environment is not right. So at the outset, it's important to recognize, you know, also DFIs and MDBs can't sort everything out, and that they need this kind of supportive environment. Anyway, so the progress has been slow, and I've kind of like going to focus, you know, you mentioned about pipeline. I'm going to just focus, you know, in a lot of my work, I've kind of argued, gone into some of the nitty gritty about the approaches of DFIs and MDBs in light of this challenge to kind of tap and mobilize kind of private capital. And so I think the first kind of observation that our work has found, and I think it's really important, is there's as a system, of course, there'll be the odd DFI or MDB, which are exceptions to this, but as a whole, as a system, there is very limited deployment of high risk capital. So when we look kind of at the portfolios of most of the institutions, I always say there's a love affair with hard currency debt, and that's kind of like the instrument of choice, and often it's senior debt. Now, as I say, there are exceptions to that, especially at the bilateral level. We see BII, the UK DFI, but also Norfund, the Norwegian DFI, who focus much more on equity investment, which is very scarce and has high development additionality product. And actually, we found an increasing allocation to debt at the expense of equity over time. So we don't see, you know, lots of high risk capital. So what do I mean by that? Equity, subordinated debt, guarantees, and insurance. And one could argue, you know, when we're looking at, you know, the flows to the poorest or most challenging of markets, that it doesn't meet the risk mitigation needs of the private sector, who probably don't want to be investing pari passu with a DFI, because essentially it increases their risk because they want their claim kind of paid first. But there are some kind of, kind of internal factors which kind of limit, I think, the use or appetite to deploy this kind of capital. So some of those which spring to mind: debt is a much simpler product to kind of manage and allows for a much more frequent recycling of capital of the DFI or MDB balance sheet. Guarantees can be much more complex. They don't expand kind of like the balance sheet, and they usually yield less than debt, but they use the same amount of capital. And equity, does require specialist kind of expertise. It ties up capital for quite a long time with kind of limited opportunities to exit. So there are some also kind of, if you like, intrinsic issues about those kind of products which may limit their use or appetite for their deployment. And this has a significant constraint, I think, in terms of the ability to obviously deploy high-risk capital to create markets or invest in those frontier technologies, etc., and transform markets, but also at the same time the kind of the mobilization at scale agenda, where often we need kind of some pooled portfolio approaches with structures where you can structure products with different kind of tranches with different kind of risk return kind of profiles using concessional finance. So the first thing is the toolkit, I think, we need to move to the deployment of more risk capital. The second and kind of related issue in terms of risk.
Not too long anymore.
Okay.
Finish off. Yeah.
The second big issue is around the Forex risk. I think we're all familiar with that, but it can make investment unviable. I was at the FIC summit. A friend of mine was telling me, I think the Ghanaian cedi had depreciated by 70% over the last 12 months. It can just make investment unviable. And it's, again, there's MDBs and DFIs, certainly on the debt side of things, lend in hard currency, and that is a major gap in the infrastructure. The paper or the chapter comes up with some ideas about how we could be addressing that. And finally, I think the business models of these institutions have been slow to evolve to this mobilization at scale agenda. So they focus more on originate to hold rather than originate to distribute. And you see that also in the kind of structures that they use. So, traditional loan syndication, AB kind of structures, very limited guarantees of kind of pooled portfolio approaches, securitizations, guarantees, little management of third-party funds, etc., etc. So there's going to be quite a significant change in the approach to mobilize capital if we want to kind of tap these large pools. And a final caveat, we need to also understand that there should be differentiated expectations in different markets. It's much harder to mobilize in the more challenging of markets. So mobilization may be more at the transaction level with a view to creating markets, and then you may see, who knows, in the kind of medium to longer term, it might be more viable for the mobilization at scale objective. But arguably in emerging markets and more kind of advanced markets, they should be focusing on that scale agenda. So I think with all the kind of the challenges and the problems that we've heard, the asks have got bigger of these DFIs, the external environment is deteriorating, it's become more challenging. And I think in my work argues that we need some quite fundamental change in how DFIs and MDBs invest.
Thanks a lot, Samantha. And can I pick up one of them? Because I think it's an advantage you're coming from the ground, because you are putting reality into the debate. So thanks for that. And when you are talking, I'm reminded what we call in corporate finance the pecking order theory. You first use your own money, then you issue debt, and as the last one, you go to the equity market. And I think you quite clearly said we really need risk capital, so equity finance. And I know, for example, the European Bank for Reconstruction and Development, they have equity investment as a Kickstarter in their portfolio. And what can we do to make sure we get more risk capital? Because that is always the easy instrument, but how can we make sure we get more equity capital? Because to absorb the risk, that's exactly what equity capital is doing. What can we do to mobilize private equity capital towards the global south?
So I think the first thing to do is look kind of, so many institutions like you just mentioned, EBRD, do have an allocation to equity, but it's not huge.
Yeah, it's small.
And so the issue is, I think, given the kind of utilization of capital and the risk associated with equity in terms of volatility and returns, etc., we need to, I guess, look at also at the risk appetites of these institutions. And you would have seen, for example, the G20 capital adequacy framework review. And there's a feeling that there's kind of some tinkering that can be done, like with credit rating agencies and how we regulate how we use kind of capital to be able to increase the risk appetite. And also we have a study coming out with Christopher Novak and myself next month, which is also arguing that there is room in many institutions' balance sheets to increase risk. So we think that there is room to kind of increase risk as a starting point. But then also I think there's a need then beyond that these institutions will need kind of additional capital, whether that's kind of capital injection and or increased use of external concessional resource. That's just kind of the internal mechanics of these institutions.
Yeah. Okay. Thanks. Thanks, Samantha. And I have one final question for Karim. Karim, Samantha mentioned in her discussion the enabling environment is extremely important. And you've been at the World Bank, but now you're back to reality in Morocco. So what is your experience? And for example, in your own case, what could African countries, what could Morocco do to have this enabling environment? Well, not only multilateral development banks, but also private flows can come to the country. What is key, to your opinion, to get right, to get the money coming?
I think we need to have, the standard things that we know as economists, transparency, autonomy, regulators that have the autonomy, governments that do the policy, good separation of the role of each other. But I would say that's not enough. Even if you do that, as we have discussed, and that's what is in the book, we still need to have a caring hands to nurture investors, particularly in infrastructure, that is, long-term investment, to take care of them to do those investments. There needs to be data on the project. There needs to be transparency. I think we need grinders, basically, somewhere in governments. A new way of doing public policies where you have, public officials or whatever, you do it in any way. But you need grinders that will sort of bridge the gap, provide the data, up to a point where we don't want the liability to end up, as we've seen too many times in Africa, by the way, where the liability ends up on the government balance sheet, and the private sector is very good at doing that. Yeah. So it's a very complex and right balance, but I think we can share experience. We can do it in a partnership, Yeah. I think Europe has a fantastic experience with countries like Spain, Portugal, Greece, and in Eastern Europe, in sort of providing a big push in investment infrastructure. What are the lessons? It was mainly through the EIB. We could do it a little bit differently. I don't think in terms of combination of what we do, us as academic or policy-oriented practitioners, and governments in public policies and multilateral institutions, I don't think that we have the right institutional cooperative framework. And we need to push for that. Where is it discussed? Who says what? Where is the leadership? So something is lacking there. I don't know what is exactly, but something.
No, but I recognize your point, and I like your word grinders. I am at Erasmus University at Rotterdam School of Management. And I always aim that some of my students go to the public sector, because I think at the end of the day, we need entrepreneurship in governments. Because exactly as you say, this grinder role, putting people together, and then it helps that you have the power of government behind you, but you need entrepreneurship to make things happen. And Stephanie stressed that as well, that we really need the government back in town for the big projects, these impact projects, where the market is failing because they don't look beyond the economics and finance of today, but they don't look for the impact tomorrow. And I think on this high note, I would like to finish this panel that we need the cooperation between public and private, but we need entrepreneurship. And Maria Mazzucato is always stressing that we need entrepreneurship back in the government to make things happen. Governments are there for the long term, for the public good. And I think the partnership with a bit of entrepreneurship is needed to get this extremely important agenda going, because we can invest in SDGs as much as we want in advanced economies. If we don't invest in the global south, then we are losing the game. So we have a joint responsibility. So to all listeners in this webinar, I would say, let's make it happen together. So thanks, Samantha, thanks, Karim, and thanks for Stephanie, who had to run back to the business of the Banco Central in Chile. Now I hand over to Uli for the second panel.
Thank you, Dirk, and all panelists for this great session. And now I have the pleasure of chairing panel 2, which we've called Developments on the Ground. And before I introduce the two panelists, I just want to mention the third panelist who was very much looking forward to join, but who unfortunately had to drop out. And that is Deepak Patel, who's the head of the Climate Finance and Innovation unit at the South African Presidential Climate Commission. And he has a very valid reason for dropping out, because as you know, next week the COP is taking place in Sharm el-Sheikh, and he was called into a briefing for the South African president, and so that's kind of important. But he has an excellent chapter on the political economy imperatives and financing needs of South Africa's just transition. And that's a really great chapter, which I encourage everyone to read, and where he's also making, among others, one really important point, and that is that the low carbon or kind of the decarbonization of the South African economy, but also other developing emerging economies, is actually also an important factor for competitiveness, specifically now with carbon border adjustment mechanisms being introduced in the European Union and elsewhere. Climate policies or climate mitigation policies are quite important also from a competitiveness perspective. But of course, when we talk about climate policies and climate finance in the global south, we also have to put a lot of emphasis on adaptation, because the destructions resulting from the physical impacts of climate change are really undermining future development. And so there's a great need for climate proofing, making economies more resilient to these physical impacts. But let me now just briefly introduce the two panelists we have in this second panel. So we have Suisa Alia-Bruchian, and I'm always I'm not very good with Thai family names, but I hope I get it somewhat right. Suisa is a actually we've written a chapter together in the book. She's head of the sustainability research at the Pui Ugapon Institute for Economic Research at the Bank of Thailand, and she's been playing a key role in pushing the Bank of Thailand's sustainable finance agenda. And we have also with us Suranjali Tandon, who's an assistant professor at the National Institute of Public Finance and Policy in India. And they will both make some interventions, and then we have a little bit of a discussion following that. So, Suisa, do you want to kick us off?
Yes, sure. So first of all, I'd like to congratulate everyone on the launch of the ebook, and thank you very much for having me here today. It's been a pleasure collaborating with Professor Uli on our chapter on sustainable finance in Southeast Asia. So with that, I think I'll just say a few words on the main trends and developments that in Southeast Asia, and share about what developments we're seeing at the country level and then at the regional level. So really in Southeast Asia, the developments have been in a very short amount of time, really just the past couple of years, we have seen really significant progress at both the level of the country and regional level, which is the ASEAN level. So from being the subject of sustainable finance being a very new topic that hardly any of the regulators or policies knew anything about, it is now very much a center of discussion in all the meetings, and it is something that is not surprising, given the context of the region. For example, we know that the Southeast Asia region is one of the most vulnerable regions to climate change, and of course, as Uli mentioned, this causes significant risk for both in terms of resilience, macroeconomic risks, as well as financial stability risks. And of course, these countries are also exposed to high transition risks. And the benefits of the finance is therefore highly needed. And this is something we need for both resilience and as well as competitiveness. And for some countries in ASEAN, it's also an existential answer as well, because without being completely flooded, they may have their existence in jeopardy. So of course, the work in the Southeast Asia has really been on laying the groundwork on creating an enabling environment for sustainable finance. So there is differences in the pace and scale at which sustainable finance activities have been undertaken, with some of the larger ASEAN countries, showing significantly more progress than the smaller ASEAN countries. Yet this is not surprising though, because given the economic priorities of each country, and also the development of the capital markets or the financial markets are also at different level stages in each country. And one thing I like to take note is that, if you look at the developments in Southeast Asia, this has really been led by an industry-led approach rather than this prescriptive approach. And this is to ensure that, sustainability is really something that is internalized by the financial institutions and not just a checklist. So, but however, as we're seeing this the past 2-3 years, as more capability has really been increased, we are seeing more prescriptive and more detailed timelines, being issued by the regulatory authorities. And if you look at the how this has progressed, which the capital markets has really been an important role in funding, and they have been really the focal area of development. So we saw this, really with a lot of early release of the bond standards, and which really set the standard for the issuance of green social sustainability bonds in the region. And we saw a number of countries from Malaysia, Singapore, Thailand also issue sovereign bonds, which is very, very promising. And given the important role of banks within the region, so a lot of the countries in Southeast Asia are really bank-led. So regulatory authorities have also been very active in promoting sustainable finance and working not only with regards to capital markets, but also on on the banking and insurance sector. So I highlight 3 main things that we have seen in the financial developments. So firstly, there's a lot of clear communication with the central banks or monetary authorities really communicating to the public, through publication of roadmaps and guidelines, about what is it they expect to see, for the financial system going forward. So Indonesia, was really one of the first countries issuing the roadmap since 2014. And secondly, reporting standards for transparency. We're seeing this with the adoption of the TCFD standards, and the Central Bank of Philippines really issuing a circular, since 2020, and Malaysia's also having practical resource for the financial industry. And thirdly, it's about the risk for the financial system. Like many countries, we're seeing a lot of discussion on having climate stress tests, And work of this is already being started in many countries in Southeast Asia. And I think over the next year or two, we should really be seeing the results of these stress tests. So moving shortly from the country level to the regional level, what we are really seeing at the region level, like I said, all 10 countries together in ASEAN have really come together to work together on creating a sustainable finance ecosystem. And so this is being done through a lot of collaboration, and discussion with different groups. So a lot of working groups have been set up, and the capital markets, led on this. We saw this with the ACMF since 2017, the launch of the green bond standards, and since then, launch of several other standards for the social bonds and the sustainability bonds in 2018. And, ASEAN, I think, is really important in that it's, bringing people together from all 10 countries to discuss how they can work together on common issues like creating a common taxonomy. So that's a dedicated task force in ASEAN now working on the ASEAN taxonomy, or maybe even on important issues like the capacity building of the people and the staff who have to work on these issues, on the ground. So, they have an ASEAN learning roadmap and the learning curriculum on sustainable finance, which I think SOAS is also working on together on this. But of course, and just to end, I'll highlight some of the challenges, that is really difficult, I think, that we've found for working on sustainable finance. And if we look at the survey, of the ASEAN countries, the most challenging is really the lack of funding and the technical capacity of the staff. So, like you said, how do we scale up this finance? How can we scale it up fast enough so that everybody is on board at the same time? But at the same time, there's also, concerns on capacity. For example, you need to have people who also know how to quantify the financial impacts and risks, and also data. We also don't have enough data collections or data registries which are already in place to look at after all these risks. So these are things that are new, and we need to put in place these infrastructure, both at the capacity level, both at the data level. And of course, with the funding, there's only so much you can do with limited resources. And, with the pandemic, with different economic issues, every country has their own challenges and priorities. And I think the biggest challenge is how do you align this across all the different, parts of the government and all the different players. And this requires a lot of coordination between all parties, and maybe changes to laws and regulations, as well as setup of governance frameworks. Yeah. So that's my.
Wonderful. Thank you so much, Swisa. And I'd like to hand over to Suranjali. And again, it's wonderful to have you with us, and the floor is yours.
Thank you, Yuri, and thank you, Dirk, for giving me the opportunity to write a chapter in your wonderful book. I'm going to take the next 5-10 minutes to talk about the experiences of India. I think this book comes at a good time because all countries are now grappling with issues with public finance, which, as I hear, is going to remain important as we move forward to meet the SDG goals in 2030. What we're seeing now is that there is an increase in appetite, but there are challenges at the same time. If you look at my chapter, it basically goes through what have been the recent developments. I think it's important to step back and also look at the context of each country differently. So, for example, if you look at the finance space in India, you have banking sector, which remains absolutely important. It is one of the major sources of finance for companies in India. The second trend that we've seen over the decades is that the Indian corporate bond market has been illiquid. So companies have been unable to raise debt through corporate bonds. And the third that we've seen is that a lot of the SDGs are actually, in fact, met through public budgets. And in this context, the government has begun to realize that the scale of finance at the moment is not adequate. Today, 42% of the budget is allocated to SDGs. But as the IMF estimates, 6.2% additionality in expenditures required annually, which is quite a bit, given that on the union budget side, there is a there's a fiscal rule which limits to the extent governments can spend and as well they can borrow. Recognizing this, over the last 2 years, there's been some serious thinking on what can be done. And it's heartening that India set up its Sustainable Finance Task Force under the Ministry of Finance, which has been thinking primarily about how to define green, which is every investor's question. Very often, these definitions do not coincide across countries. And that creates a conflict because, as we're saying, it's not always domestic investment that will be available. And to that end, there's been quite a bit of work on taxonomy, and it's heartening that it's gone beyond sustainable finance to also talk about just transition as one of the pillars. We saw this year the Reserve Bank of India, which is the Indian Central Bank, which is particularly conservative in its approach. For many years, it shied away from joining the NGFS, but very swiftly in 2021 joined the NGFS and then began its work on assessment of climate risks. And now put out a paper in 2022 asking banks on their preparedness on disclosures as well as stress testing. And that marks a significant shift. I say this because the Indian banking sector has been under stress for many years. We've seen bringing of non-performing assets on books, which basically limits to the extent banks can extend themselves. So with this, I hope that there will be a disclosure framework which is largely aligned with the TCFD, which will be in place over the next couple of years, which means that the banking sector will rejig to finance projects which are green and green plus. The third development, which I think is also instrumental for private sector investors, has been the disclosure framework. So very often investors want to be told exactly what the penalties are or what the guidelines are on investments in certain projects. And so we have the responsibility reporting, which is now mandated for top 1,000 companies. And if you look at the Indian market, the corporate sector is largely concentrated. So if it covers 1,000 listed companies, it covers the big emitters. And in that sense, it provides transparency to those moving to the market. But even having said so, you look at secondary markets, which are mutual funds or other pool funds that put their money into these companies, they constitute a very small fraction. So while we are getting there, we're not quite there. It will take a massive level of scaling up. And that is exactly the question, Yuli, that you've been asking through your book. And it's an easy answer to say that public finance will have to carry the weight. But I assume that there will be models of a pooled financing which will be emulated in India. I see some trends in that. There's been impact investment, which catalyzes finance, which is part philanthropy, part state. So in fact, in India, we issued the first skill development impact bond. It may not be large in scale, but it promises to unleash a new type of partnership. And the government has also relayed its interest in the sovereign green bond, which means that public finance again will play an important role. So I'd like to say that the global south is in need of capital, as I started with the numbers. There have been regulatory changes which are catching up. But of course, private finance will have to be onboarded with, I guess, stricter norms and regulations and perhaps clearer definitions for India. I'll stop there. Thank you.
Thank you so much, Suranjali. So you've both told us that quite a bit has been going on, both in Southeast Asia, also in India. But where do you see kind of the key challenges to advancing this whole agenda. So what, what are the main actions that should be taken either nationally or regionally or also internationally to advance the whole agenda to support that? Sweet.
Yes, thank you. So that's a, right, a challenging issue, I think, that everybody wants to find. So, but I think, we are, it's, I think that's not really one answer, but I think we have to do a number of things at the same time. So I think one approach that is really working is that we are really seeing a lot of more collaboration, I think, from going. So before, we will see it's become more of each country working on their own plans, working on their own policies. But I think in the past year or so, we're seeing a lot more collaboration, not just between cross-country, cross-regional, but from even the Asian region to China or to Europe, we're seeing a lot more cross-regional collaboration, which I think is really something that's important for us to scale up this, because it's not something that is just limited to one country or one region, but it's a global scale. So we really need, I think, to really focus more on collaboration across different jurisdictions, across different regions, and we can really share on the knowledge and expertise between the regions. And another fact that I think that we hasn't been as increasing talk, but I think we should really need to explore is maybe the use of green technology. And I think this is something that which can be used in a variety of ways, to not only scale up the financing with, how can we create ecosystems of data, that it will help scale up the finance, or maybe, and of course, this is something that is, I think, a problem or challenge for many countries. And, how do you really assess the impacts and the risks without the sufficient data? So I think this is something we can explore a lot more using technology as well, and greater cross collaboration between regions. So those are my two, I think, main points.
Thank you, Suisa. And actually, we have a chapter in the book which I co-wrote with Marianne Haar and Simon Dikau on how to use different fintech approaches to really push sustainable finance in many ways. And I think one really important thing that central banks and supervisors can do is really help create a data infrastructure, because the data problem always comes up, but it's been coming up ever since I started working on the topic, which has been quite some while ago, and somehow it always seems to me that everyone's waiting for someone else to magically provide the data. And the great thing about central bankers and supervisors is that they can actually help create the data. And I think we have now a lot of technology at our hand that can help to kind of automate data generation and make through open access data platforms really make the data available to financial market participants and also supervisors to then assess risk, assess impact. And I think that ought to be a major agenda going forward. And I think that actually connects very well with what you said about the importance of regional cooperation and international cooperation. And so I think this is really a very critical issue. So thank you. Suranjali, do you have, for my super big question, do you have some answers?
Yeah, I just wanted to quickly mention that instead of looking at all the SDGs together, I think there needs to be a more pragmatic approach to look at each of the SDGs and look at where private finance would be willing to come in, because there's always this question of returns and risk. So I think you could create all of us together in terms, should be thinking over the next couple of years on what are the kinds of instruments and where would public finance be the most essential among all the SDGs. So I think that is one important thing. And the other is, of course, on definitions. So countries should get their taxonomy right, obviously depending on their own priorities. But that's absolutely important for scaling up of this investment.
Yeah, thank you. And I think one thing that is really critical also is that we need to be very clear that there are a lot of areas when we look at the SDGs where private finance will not go. Because when we talk about development, when we talk about the SDGs, we also have to talk a lot about public goods. And Stephanie in the previous session referred to market failures and short-termism of finance, but we also have to see that there are in the SDG space and also the climate space, certain types of investment that will never really attract private finance. So we need to look at public finance. And on the climate end, of course, adaptation, which is so vital, I mean, vital in the literal sense for countries. In some adaptation areas, you can draw in private capital, but many adaptation projects really are not viable from a commercial perspective. And so public finance, which you, of course, also highlighted in your previous intervention, has to play a key role. And I think that also partly brings us back to the discussion around MDBs, about national development banks that can undertake certain projects that do generate these public goods, which otherwise will not get financed. So I know Dirk is also around. So if Dirk, if you want to come into the discussion, don't hesitate. Oops, just my screen went away. But yeah, so on the public finance aspect, now everyone's been highlighting that we do have serious debt problems in many parts of the world. I mean, and I think we have to also look at ways of getting advanced countries, despite their fiscal challenges, to really step up. Because when we talk about climate finance, of course, the international justice dimension, cannot be ignored, and the cost that developing countries are incurring now are basically caused through historical emissions, largely from advanced countries. And I think, which brings us again then to the question of how to mobilize capital from the global north to put to good use in the global south. And here, of course, the national frameworks and kind of ability to absorb this capital is really critical. I don't know if any of you has some final thoughts on that.
Shall I go, Uli?
Yeah, sure.
Yeah, I think it is the old-fashioned word of solidarity. Countries are creating financing for their own, and if we don't get this collective common goods, what we need at the COP in the next weeks in Egypt, and the same for financing, we need to develop this common good thinking, what we have lost in the neoliberal approach. So I think it is really coming down to feel the shared responsibility to work together for this agenda, and that's the only way to go forward. And then we can refinance, scale up the multilateral development banks, and then we could do lots of things. But it starts with the feeling that we have in common public good with the SDGs and with climate mitigation.
Thank you, Dirk. And sorry, Karim, of course, you're also welcome to chip in if you like. But Suisa, Suranjali, some final thoughts from you?
Yes, I think something that, we saw echoed in both panels is that, we really, something that which has to be done collaboratively. I think this is, as Doug mentioned, it's a shared responsibility between all players. And I think that's really a key message that we should really keep in mind when working on this. Yeah.
Thank you. But there's also in a way, we all agree that it's a global problem, but we also see that there's a lot of global free riding,
yes.
And free riding, particularly in the north.
Really, I'd just like to add one more thing, which is to say that while we're looking at sustainable development goals, we also have to recognize that the transition entails scaling down of revenues that are accruing from fossil fuels to certain countries. And that is, in a sense, a double challenge for developing countries. And that requires developed countries to sort of step up and say that, there will be support available from their balance sheets, because they've consumed goods which have exhausted the carbon budget for these countries. So I would say that that is also required to be factored in policy going forward.
I think that's a very important point, and in a way that's also linking to the issues that Deepak has discussed in his chapter, because South Africa is indeed now very much at the forefront of trying to engineer a just transition, reducing its carbon dependency, and as I mentioned, also from a competitiveness aspect of the economy. But it's not easy at all. But the reality is also that countries that don't address head-on these transition risks are likely to end up with large stranded assets, and so fossil fuel based, economies that are heavily dependent on the extraction of fossil fuel, also for exports, they may find themselves in a very, very difficult spot going forward if they don't diversify out of fossil fuels, which in the short run is a big challenge, but in the long run, if they don't do that, it's going to be an even larger challenge, and for sure they also need support. So clearly the issue of international cooperation has come out very clearly in this, but I think we also must acknowledge the great urgency. This was supposed to be the decade of action. The investment needs to happen now. And not just in 30 years or so. So we need to get the money flowing really now. And so there is a big agenda that needs to be pushed. Progress or discussions recently have not been so encouraging, because kind of G20 international cooperation is not really very successful right now. The annual meetings at the World Bank, IMF, a few weeks ago, where there was a lot of business as usual still, and the sense of urgency is still somehow not reflected in what's happening. So we need to be pushing this jointly. And with this, again, thanks so much for all panelists today. Also to all contributors to the book. It's been really a great pleasure, honor working with everyone. And I think we hopefully have produced jointly something that will help the discussion. And this was not the last exchange we've had on the topic today. So thanks everyone. Also thanks a lot to all participants of the webinar today. And well, let's keep on the good fight. Thank you and bye-bye.
Thank you. Goodbye.
Bye.